Indicators of fundamental analysis that most traders follow on the stock market and which have a significant impact on the movement of the currency pairs are movement of gross domestic product, interest rates, inflation, data on employment, trade balance, indicators of retail, information about real estate, indicators of industrial production. Gross domestic product is the sum of goods and services produced by domestic and foreign companies in the country. There is a real and a nominal gross domestic product, and as a more precise indicator is used real gross domestic product. This is a very important indicator for traders in the stock market. Of course, growth of gross domestic product affects the strengthening of the domestic currency, while the decline in gross domestic product affects the weakening of the domestic currency. Interest rates are one of the most important factors that determine the value of currencies in the foreign exchange market. Since the currencies in the market are in pairs, it's necessary to follow the interest rates that apply in countries for both currency in pair. This relationship between the interest rates is called the interest rate differential. Information about interest rates have a large impact on currency movement. For example, if there are certain indications that interest rates will decrease, certain currency will be sold before the information is published. The biggest changes in the value of currencies are caused by unexpected and unknown changes in interest rates. A general rule that traders use is that the tendency of weakening during a long period of time have currencies with lower interest rates, while the tendency to strengthening during a long period of time have currencies with a higher interest rates. As for the interest rates, they tend to grow over the economic cycle of expansion and tend to fall during economic recession cycle. Indicators of inflation also have a huge influence of currency exchange rates because they have an impact on the reduction or growth of interest rates in the country. Every country has measures to manage inflation, and this sort of activities is closely monitored by traders. To track inflation and on that basis make conclusions about whether the national bank might take measures to regulate inflation, for example, rising or reducing interest rates, traders use the following data: index of industrial price and consumer price index. Index of industrial prices comprises of information from economy sectors such as manufacturing, mining, and agriculture. It includes food products, energy, fuel, machines, equipment, vehicle, etc. This index does not include imported goods, services, and taxes. Consumer price index is the average price changes of the market basket. Consumer price index data consists of the samples on the price of food, shelter, clothing, fuel, transport care, and health care. This index is considered a base inflation indicator, and the data for this index are collected from 19,000 retail stores and 57,000 households, while the structure of the market basket is 44% of goods and 56% of services. Employment data are important economic indicators that represent the strength of each country's economy. This indicator tells us about the number of new open and closed work positions as well as the percentage of the active workforce. Standard indicators that traders are interested in are unemployment rate, industrial payroll, non-farm payroll, the average salary, and the average work week. In general, the most significant data on employment, especially when it comes to United States, are industrial and non-farm payroll, and the second is the unemployment rate. Trade balance represents the difference between the imported and exported services and products. It is important to point out that traders should focus on the 3-month seasonal custom revenues because the month-long are considered as unreliable. Countries that export more than they import are in a positive trade balance, which for results have strengthening in currency. countries that imported more than it exported is in a negative trade balance, which leads to a weakening of the currency. These parameters have a significant influence on the value of the currency because a positive or negative trade balance shows the competitiveness of the domestic economy in compared to the foreign countries. Retail is one of the most important indicators of consumption for traders in the foreign exchange market. This indicator shows the strength of consumers' demand as well as the changes in the volume of retail sales. It is available on a monthly basis, but because of frequent fluctuations and seasonal character, makes more sense to observe on a quarterly basis. Retailing is an important economic indicator for United States of America because the focus of the US economy is consumer. If a consumer has a sufficient wage, he will be able to spend more and thus comes to a greater demand for products and goods, which result in an increase in production. For traders, this is an important indicator because consumption in retail measures strength of the economy and therefore the strength of the currency. Information about real estate provide a sense of optimism of consumers and of their ability to buy more expensive goods. These data are strongly connected with interest rates because they affect the height of the loan interest. Lower interest rates on mortgage loans lead to greater demand for those loans and thus comes to greater demand for real estate. This sector of the economy is very important for every country because it affects the development of other sectors such as the construction of roads, then starts the production of furniture and all the other things that are necessary for the equipping of living space. The higher the value of this indicator marks a healthy development of the economy, so the increasing of his value has a positive impact on the national currency. And industrial production indicators consist of the total products of national factories, mines, utilities, and so on. It is published every 15th of the month. The data are for the previous month. This indicator is related to gross domestic product, so that has a major impact on the value of exchange rates. In the United States, 40% of the total economy is off to the industry, which means that has a significantly impact on GDP and the value of the US dollar.